Difference between stocks and index funds 101. A stock gives you one share of ownership in a single company. An index fund is a portfolio of assets which generally includes shares in many companies, as well as bonds and other assets. This portfolio is designed to track entire sections of the market, rising and falling as those segments do. What are index funds? An index fund is a type of mutual fund or exchange-traded fund, ETF, with a portfolio constructed to match or track the components of a financial market index, such as the Standard & Poor's 500 Index, S&P 500. An index mutual fund is set to provide a broad market exposure, low operating expenses, and low portfolio turnover. Those funds follow their benchmark index regardless of the state of the market. Are index funds better than stocks? Because they are diversified, investing in an index fund is lower risk than owning a few individual stocks. That doesn't mean you can't lose money, or that they are safe as a CD, for example. But the index will usually fluctuate a lot less than an individual stock. As a general rule, index fund investing is more advantageous than investing in individual stocks because it keeps costs low, removes the need to consistently study earning reports from companies, and most certainly results in being average, which is far preferable to losing your hard-earned money in a bad environment. Can I lose money with an index fund? Do index funds eliminate risk? Much of it, yes, but not entirely. In a broad-based sell-off of a market, the benchmark index will lose value accordingly. That means an index fund tied to the benchmark will also lose value. If you like the information provided for you today, please like the video and subscribe for more. Thank you.